Welcome to your first video about Intermediate 1. So we start with a heavy review. And because most of this is review, I'm not going to bother going through in a real strong detail unless I feel like those concepts are just invaluable and will be repeated over and over throughout the course. Many times you might hear me say, you can read through this. That doesn't mean that I don't need you to know this information. That doesn't mean you won't see this information tested or need this information. It just means that I don't need to read through the words that I have written on the page because it would just take up time on this video. And I don't believe these concepts are something you need me to really give additional insight into. For example, we start off with the basic definition of accounting. And accountants are identifying, classifying, measuring, and communicating. We talk about the difference between managerial and financial accountants. Not a big deal. It's all about the audience. You've taken 2 courses. You probably know this already. Financial accounting is going to be the entirety of this course. We are talking about preparing financial reports to facilitate companies' ability to register on the public markets, like the New York Stock Exchange, the NASDAQ, the American Exchange. All companies must submit some sort of financial report, a very official report called the 10K, in order to trade on those public stock exchanges. And so in order for there to be a sort of transparency for the company, financial accounting provides these reports to the public. It is publicly available. You can find all of these reports online through a search engine called Edgar that's on the SEC's website. Basically, it allows insiders to see within the company. I'm sorry, outsiders to see in the company. As I mentioned, companies that trade on these US markets have to submit annual and quarterly reports to the Securities Exchange Commission, the SEC, and those reports will be looked at by the SEC, which is a regulatory body, to make sure that they conform with standardized principles. That is what we know as US GAAP. Now, the focus of intermediate accounting tends to be on the reports, the 4 reports. However, that doesn't mean that there's not a lot of other information in these large annual reports. We'll look at them throughout the class. These are just the highlights. These are 4 pages of perhaps 70 to 100 pages in these filings. So that you're familiar with the technical terms, annual reports are called 10K filings and require an audit, right? The auditor has to render an audit opinion on the annual reports of any company that wants to trade on public stock exchanges in the United States. There are also quarterly reports that are required. However, these are not, there's not an official audit of these quarterly filings. They're called 10Qs. And the auditors simply review them. That does not have the same weight, the same scrutiny as they do with the 10K when they have to provide this audit opinion. And so really what occurs in this cycle, it's a real kind of high level cycle. There's a lot of other items that go in here. We have business transactions that are being recorded by the company. So these are usually recorded by internal accountants or corporate accountants. So every company, of course, has their own staff of accountants, and they're recording all the transactions of the company, and they will put together the financial reports of the company. They will prepare all of the items that go into the 10K and the 10Q. These will also be audited by our audit firms. In the case of it being a 10K, There's other little mechanisms that are in there where the companies have audit committees that select auditors and have relationships with the auditors, make sure the auditors have everything they need, make sure the auditors are able to do the work that they're supposed to. Also within this is that the CEO and the CFO have to sign off on the reports. This came after the Enron debacle, where there was some issues with how the audit was progressing. One of the big audit firms, Arthur Andersen at the time, had to dissolve due to the scandal that was involved in that failure of accounting. And the CEO and CFO were, in that case, able to hedge a bit and say, well, hey, we didn't really know what was going on. Now, after that, Sarbanes-Oxley was passed, and the CEO and the CFO do have to take legal responsibility for the reports submitted so that that doesn't occur in the future. All of this boils into an annual report because, again, remember, this is publicly available to the United States or anybody who wants to invest. We will look at Edgar and pull up some reports to show you how easy it is. But now we have the ability of outsiders to look through the annual reports after they've been submitted to the SEC. And that's when the external users are able to make investing decisions with these reports, or perhaps even loan. Right? Basically, we're giving outsiders the ability to make informed decisions, even though they're not within the company itself. So that's the process. That's the importance of it. This is why accountants are absolutely necessary. They can play a part in many different aspects of this. They could work within the company that's creating the reports. You can be an auditor that's auditing the reports of companies. There are accountants that are CEOs and CFOs of companies. That is something that's also required of many boards, is to have a CPA on the board so that you have that level of financial expertise in evaluating the reports prior to them being shipped out, filed with the SEC. The SEC checks them for compliance again. So we have a multi-tiered system under which we are scrutinizing the validity of these reports so that these external users can make investing decisions, loan decisions, whether or not they want to give the company their money and whether the company will use it efficiently. So GAAP is the rules, right? This is a strong, large, codified system of rules. And that's what we'll be learning. That's what you'll be learning in Intermediate 1, Intermediate 2, Advanced Accounting, all of the rules that impact how we record business transactions and ultimately compile, create financial reports. What is GAAP? So it is created by the SEC. It was initially started by the SEC. Now, the SEC was created a long time ago, right? In 1929, this is when we had the great fallout, the depression of the early 20th century. And the markets collapsed. So people thought, hey, we need to have a little bit more structure around how businesses are reporting to restore faith in our systems. So after that 1929 collapse, the SEC was created by the government. It is a governmental body. It is a regulator now. It's a regulator, which means a regulatory body. It enforces accounting standards, and it has punitive powers for noncompliance, which means it can punish companies if they fail to comply. The SEC does have the ability to set accounting standards, but chooses to do so only in rare circumstances. So they are not the ones that write the rules. So what the SEC did as one of its first charges is saying, look, yeah, we will be the governmental body that makes sure people are reporting correctly, but we don't want to write the rules as well. We would rather have that be in the hands of a private body. And so there have been a few different types of private standard setters. The most successful and the one that exists today is the FASB, the Financial Accounting Standards Board. So if the SEC are the regulators, right? They're the police, basically. They're making sure people follow the rules. Then the FASB is the legislative body. They're the ones who are creating the rules. Now, you can find all of the information about US GAAP. It's publicly available, right? It's all been codified into a unified system. It used to be numbered rules, which was a pain to remember. Like SFAS number 157 deals with fair value, and SFAS 328 might deal with hedge accounting. And there was no rhyme or reason. It was just chronological order, more or less. Now they have a much more intuitive, easy to search system so that you can look up, if you weren't sure about the accounting for something, you can look it up on this website in a relatively straightforward fashion. Now, once you find it, yeah, the language is not straightforward. If you think textbooks are hard to read, this makes me sweat sometimes when I'm reading through it. It's just obviously written in a very legalese, high level language, right, to cover all of its bases. One thing to note is that when the FASB is developing these standards, it doesn't do so without any forewarning. So when they are developing a standard, they consult. It's open to public and it has full disclosure. They even issue a draft of the standard. They solicit feedback on the draft from the general public, usually audit firms, companies, businessmen, practitioners, academics will give feedback, and the FASB will consider this feedback when they tool through and try to modify maybe some of their writing. The point is, companies are well aware when a new financial accounting standard is coming down the pipeline, and this certainly is not a one and done. They are continuously always updating, modifying accounting standards. And so part of being a CPA is keeping up with the most recent pronouncements from the FASB and how they are handling accounting standards. Now that's US GAAP, right? The FASB is over US GAAP. They codified it into the Accounting Standards Code. The SEC is the regulator. There is one other system that is allowed on US public markets. So international financial reporting standards also can be used. This is allowed for international companies to use these reporting standards and still trade on public markets. Of course, domestic companies here in the United States could use this as well and trade onto our markets. However, it's not very common unless that company is based in another country. It's headquartered in a place outside the United States. So just be aware there is this other standard body of rules. They tend to be a little bit more principles-based versus rules-based. So basically, it leaves a little bit more up to interpretation. It involves more professional judgment. It's less of a blow-by-blow of exactly what the rules are. Okay. So what's the purpose? The first thing that GAAP really tries to address is, what are we trying to do with our codification, with the rules? What should our goal be? And the goal is to provide information that is, in general, useful for the efficient allocation of resources in capital markets. So that sounds like a complicated phrase, but let me break it down. Basically, we want the companies that are likely to be the most successful and the most profitable, the most desirable, right? The ones that are going to use resources well. We want to give them the most money from investors and creditors. That's the efficient allocation. We should give successful companies that ability to raise money to operate and provide a good or a service that is demanded and therefore successful. At the same time, we don't want to give and allocate money to companies that might fail, that might not have a product, or might not be practicing their operations in a manner that is going to propel them in the long run, right? Because that would be a waste of money. So in order to do that, basically we should have money that's useful in investment and credit decisions. Investments involve equity. Right? This is a stockholder. Credit decisions are bonds. This is not an owner of the company. This is someone who is loaning the company money, a very big distinction, which we'll talk about more. Useful in assessing future cash flows. That sounds pretty straightforward. It is. Basically, how will the company be bringing cash in the future? And it wants to know about the enterprise's resources, the claims on those resources, and any changes in them. Resources are basically assets. Claims on the resources are liabilities. And changes in the assets and liabilities of the company. So we get this primary charge that we want to provide information that is useful in the efficient allocation of resources. And these are the things that we believe will help people help that goal. These next pieces are, again, somewhat straightforward. Now, what makes the information useful? I don't want to dive too, I don't want to read all this to you. Well, information should be relevant. It should have predictive value. It should tell me about the future. It allows me to forecast, or it should have confirmatory value. It should either tell me that opinion I held in the past was right or it's wrong, right? It allows me to update my views. So that's the relevant piece. One thing that is, something you really want, a term that you might not be familiar with, these you probably are a little bit more familiar with: relevance, predictive, confirmatory, materiality, right? Materiality is a standard of relevance. It's a threshold of relevance. If something is material, then it would make a difference in a financial statement user's decision. So if something is material, then we have to apply GAAP, right? If an item is not material, so if it's not relevant, if it doesn't change the decision an investor or creditor would make in a company, then we still have to report it, but we may be able to record it in a manner that is not GAAP compliant. So we're talking about perhaps small dollar values, but not always, right? We got to have a little bit of judgment in that. I won't get too far into the professional judgment, but understand that we have to record everything. Now, if it's not material, if it's immaterial, 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 then we have to record it, but we can record it outside of GAAP. This term will come up a lot in auditing for sure, and some of your other accounting courses. So just be familiar with it. Faithful representation. It's something that can be a little hard to get our hands around, but I do want to make sure that we understand what faithful representation implies. It has to be complete, neutral, free from error. You can read that part by yourself, but basically a more direct way of stating it is that if you're familiar with the concepts of being the letter of the law and the spirit of the law. Okay, we'll talk a little bit about this in class. Faithful representation attempts to meet both the letter and the spirit. And so, just a short idea of what does that mean? If you've never heard this phrase, letter of the law, spirit of the law. Letter of the law is all about the form of the transaction, right? Does the transaction check the boxes? If we're calling it a liability, does it meet all of the very superficial designations of the liability? Right? Spirit, on the other hand, is the underlying nature of the transaction. Is that in line with what we're calling it, with the boxes we're checking? Or is it a wolf dressed in sheep's clothing, right? Is it something that isn't a sheep, but is just putting on all the trappings, the fur, and baaing like a sheep would. So there's this little piece that we'll talk a little bit about in class, faithful representation. Basically, it's about a type of stock that was issued. And I want you guys just to think about what is the underlying substance of this? What is its official form? So what is the spirit of this transaction? Is it debt or is it equity? Is its form, is its letter of the law, is it meeting the definition of debt or equity in its form, right? So that's just something to think about. I'm going to end the first video right here, and I will pick up again in the next.